It's great to have your company for the weekly this Friday, the 16th of July. I'm Jessica Amir, a senior market analyst with Bell Direct. Well, despite Sydney being in an extended lockdown until at least the end of July and Victoria entering a 5-day lockdown, investors have been pretty busy buying into sectors that are likely to do well on the other side of COVID, such as utilities. And investors have also been backing mining companies, benefiting from increased demand for Aussie commodities. So if you look at the sectors, the utility sector up the most Monday to Thursday, 4.5%. That was largely thanks to the electricity company Spark Infrastructure, SKI, receiving a takeover offer for $2.70 per share, an offer that Spark later rejected. Either way, it was a fresh vote of confidence, lifting SKI shares up 17%, making Spark the best performer in the top 200 stocks and took Spark shares to a 4-year high. And secondly, with investors backing mining stocks, the materials sector also rose 4% too. Now, it comes as we learnt that exports to China surged to a record high at a time when the iron ore price also rose to a record too, a brand new high of $218 US. So for investors, this means mining companies should see increased cash flow and earnings, and so should engineering companies, which make up the industrial sector or form part of it. As a result, utilities, materials and industrials all outpaced the Aussie share market's rise of 0.8% Monday to Thursday. Now, as for other stocks in the leaderboard, there's a few worth highlighting. Mining contractor NRW Holdings, NWH is their ticker code, their shares up 12%, seeing NWH claim the second place in the ASX 200 podium, and NRW shares charged to a 2-month high. So why the sudden rush to back NRW? Well, the company announced it's selling $81 million of mobile mining assets that are currently being used at a coal mine. Now, this will effectively reduce the company's debt from $115 to $34 million, which is a good thing, but it will shave earnings by $1.8 million per year. Now, Macquarie reckons that'll take off 1 to 2% of total group earnings. So Macquarie is cautious for the near term, but says NRW is a buy with a $2.10 target, implying 20% share price growth in a year. Why? Well, the investment bank thinks that it should recover and do well because it's got a large order book and secondly, a strong tender pipeline. Now, on the flip side, the buy now, pay later space lost its mojo. Afterpay APT down 11%, Zip Z1P down 17. Now, both stocks saw heavy selling because Apple announced they're entering the buy now, pay later sector. As a result, a lot of brokers were downgrading the ASX buy now, pay later stocks amid increasing global competition. And also keep in mind the charts are also suggesting further selling pressure is ahead for Afterpay, the biggest tech stock in Australia. But after a period of consolidation and a pullback over the long term, Macquarie and Morgan Stanley both see Afterpay recovering. Morgan Stanley, the most bullish, $145 price target for Afterpay. Now, moving to what to watch next week and beyond. The first item is lithium stocks. Quoting a character from Disney's Toy Story, some investors might be thinking lithium stocks are going to infinity and beyond, thanks to soaring EV demand and a lack of lithium supply, which is pushing up lithium prices and as such, lithium stocks. Now, in particular, Orocobre, ORE, their shares rose 11% to a record high of $7.48 this week. So Macquarie and JP Morgan both upgraded ORE's price target to $8.20 and $8.45 respectively. So why the bullish sentiment? Well, firstly, at a sector level, JP Morgan thinks the lithium price will strongly grow to 2025 because there's a 10% supply deficit. Or while JP Morgan says demand is aggressively growing. As such, the investment bank sees lithium stocks and particularly Orocobre benefiting from increased earnings. And secondly, for Orocobre, it's worth noting earlier this month, the company reported it's receiving better lithium prices at its Argentinian Olaroz facility. Lithium prices are up 170% in 9 months. And it's producing better lithium grades too, which is what electric vehicle companies need. In fact, 66% of its production in the June quarter was what's called battery-grade lithium carbonate, and that's a 45% improvement on the same time last year. So for shareholders, this simply supports Orocobre's earnings being likely to continue to grow, and given lithium prices and grades are higher in the area too, it also puts other lithium companies in the same area in the spotlight, like Lake Resources, LKE for example. They're a junior company that operate next to Orocobre. Now, it's not in production like Orocobre, and it also doesn't have large companies like Toyota invested in its business. But LKE shares are up a massive 400% this year. And thirdly, why else is lithium and Orocobre particularly hot? Well, Orocobre may merge with Galaxy Resources GXY, which will create the 5th biggest lithium company in the globe, listed right here on the ASX. What's next in this potential merger? Well, shareholders will be voting, the outcome likely to be announced on the 6th of August. If approved, it's over to the courts to decide, so keep your eye on ORE and GXY shares. And lastly, and separately but not least, for what else to watch next week? Well, the Reserve Bank of Australia meeting minutes are released on Tuesday, the 20th of July. And given the New South Wales and Victorian states are in lockdown, and the RBA previously flagged that it would reduce the amount of bonds that it buys from November, many will now be expecting the central bank to flip on this decision and potentially increase support again. In other words, economists might expect the RBA to say it'll move to buy more bonds to essentially keep businesses' borrowing costs low. And that supports the stock market. And that's the weekly with plenty of considerations for your portfolio. If you've got any questions, please leave them in the comments section on YouTube. From all of us here at Bell Direct, have a happy and safe weekend. I'm Jessica Amir. Bye for now.